To understand why governments are cautious about Bitcoin, it is very important to understand the role that fiat currency play in a country's economy. So let's get started on this another episode of the relationship between the governments and crypto, presented to you by the Pedo News Network. Now, fiat refers to conventional currencies issued by government. Fiat money is backed by the full faith and credit of a government. This means that government promises to pay the borrower of a currency whole in case of a default. The US government relies on the Federal Reserve, a central bank on which Congress only has a partial authority to print or create money for its economy. The cycle of transaction in the US economy, one that involves borrowers, lenders, and consumers, relies on a chain of trust between transacting parties. The Federal Reserve, which is also known as lender of the last resort, is the final leg of this chain. Governments facilitate the role of central banks in an economy. While central banks are involved in making policies related to money, they do not have the authority to regulate its use. That responsibility lies with central government. Through a series of intermediaries such as banks and financial institutions, government distribute and regulate the flow and use of money in an economy. Thus, they can dictate how it is transferred, sectors where it is distributed, and trace its utility. They also earn revenue from it by taxing the earnings of individuals and corporations. Now, Bitcoin is a decentralized system that has the potential to dismantle the system described. Its network does away with intermediaries and, by extension, the element of a government system. Government often institute capital controls to prevent outflow of a currency because exports could debase its value. For some, this is another form of control exerted by governments on economic and fiscal policy. In such instances, the stateless nature of Bitcoin comes in handy to circumventing capital control and exporting wealth. One of the more well-known instances of a capital flight using Bitcoin has occurred in China. The country's citizens have an annual limit of $50,000 to purchase foreign currency. A report by China Analysis, a cryptocurrency firm, found that more than $50 billion moved from China-based Bitcoin wallet to wallets in other countries in the year 2020, meaning Chinese citizens may have converted the local currency to Bitcoin and transferred it across borders to sidestep government regulations. Now, government in most of the major global economies argue that the ability to bypass existing financial infrastructure for a country is a blessing in disguise for criminals because it enables them to camouflage their involvement in such criminal activities. The most famous example of a crime invoking in Bitcoin was a Silk Road case. Briefly, a Silk Road was a marketplace for guns and illegal drugs, among other things, on the dark web. It allowed users to pay in Bitcoin. The cryptocurrency was held in escrow until the buyer confirmed the receipt of goods. It was difficult for law enforcement to trace parties involved in the transaction because they only had blockchain addresses and they are very difficult to identify. Eventually, however, the FBI was able to take down the marketplace and they seized over 174,000 Bitcoins. The case for Bitcoin as an alternative to central bank is based both on economic and technology. Satoshi Nakamoto, who is the founder of Bitcoin, defined the cryptocurrency as a peer-to-peer version of electronic cash that allows for online payment to be sent directly from one party to another without going through financial institution. Now, within the context of a financial infrastructure system dominated by central bank, Bitcoin solves three major problems. First, it eliminates the problem of double spending. Each Bitcoin is unique and cryptographically secured, meaning it cannot be hacked or replicated. Therefore, you cannot spend a particular Bitcoin twice or counterfeit it. Second, even though it is decentralized, Bitcoin's network is a still more trustworthy system. In this case, trust is an algorithmic construct. Transactions on Bitcoin's network have to be approved by nodes spread out across the world to be included in its ledger. Even a single disagreement by a node can make the transaction ineligible for inclusion in Bitcoin's ledger. And the third reason is that the Bitcoin's network eliminate the need for a centralized infrastructure by streamlining the process to produce and distribute the currency. Anyone with a full node can generate Bitcoins at home. Intermediaries are not required for peer-to-peer transfer between two addresses on Bitcoin's blockchain. Therefore, a network of banks chartered by a central authority is not necessary to distribute cryptocurrency. In 2014, as regulators in New York were exploring ways to control Bitcoin, executives at Wall Street's biggest bank fretted that regulating cryptocurrencies would also legitimize them, and that would threaten the entire financial industry according to them. So they tried to sow doubts in the mind of ordinary people. At the World Economic Forum in Davos that year, Jamie Dimon, who is the chief executive of JP Morgan Chase, which is the nation's largest bank, called Bitcoin a terrible store of value that was also being used for illicit purposes. At a meeting to discuss violation of Iran's sanction, Mr. Cohen, the finance industry's preeminent lawyer, warned the state's regulator that the federal government was very worried about Bitcoin and its uses. Those efforts failed as New York's Department of Financial Services began issuing licenses for Bitcoin businesses in 2015. There are now more than 75 million users of Bitcoin, up from around 3 million 7 years ago. And the number of digital currencies has exploded. Globally, 220 million people use cryptocurrencies, according to a July 2021 report by Crypto.com. Now the banking industry is racing to catch up. Bank wants to compete in this new world and profit from it. Their approach is two-pronged. First, they are experimenting with cryptocurrency offerings. And secondly, they are lobbying regulators to create rules that work in the favor of their banks. Some are offering cryptocurrency investments to their wealthy clients. Others are weighing trading desks for Bitcoin. JP Morgan even started its digital currency in 2019. And instead of warning regulators away from cryptocurrency, banking industry representatives now complained that regulators have not acted quickly enough and that their inaction is costing banks valuable time in their mission to compete. But the fact is that their initial skepticism has costed them time. An alternative financial world is springing up around the traditional banking industry. Cryptocurrency startups are beginning to offer credit cards, loans, and other banking services. People and businesses around the world are embracing digital currencies at a rapid pace. Even governments are getting involved. El Salvador now accepts Bitcoin as legal tender. And the Federal Reserve, following in the footsteps of central banks around the world, is evaluating launching its own digital currency. Digital currencies which let individuals bypass banks in money transfers, sales, and business collections by connecting people instantly without an intermediary are threatening to take away the role that central bank plays. Regulators who were caught off guard by the rapid adoption of cryptocurrencies are scrambling to write new rules governing their use. And banks see a fresh opportunity to lobby regulators on writing rules in a way that benefits them. Bank lobbyists are pushing regulators hard for a uniform rules around cryptocurrency-focused lender and other companies that transfer money and offer services similar to that as of traditional banks, arguing that unless they are subjected to the same controls as the bank faces, the newer businesses will enjoy an unfair advantage. American banks are also taking a stand against the Federal Reserve's exploration of its own digital currency. The American Bankers Association, which represents the largest US banks, warned members of the House Financial Service Committee this past summer that negative consequences of creating a central bank digital currency in quotes could be severe. The association said there did not seem to be a pressing need for one because the dollar is largely digital today. Mr. Cohen, who is a senior chairman of law firm Sullivan and Cromwell, who years earlier warned New York regulators of Bitcoin, is among those pushing for greater regulations. We hope that you now understand how Bitcoin and crypto are threatening the existence of banks and central banks around the world. Also, we have a detailed video on why IMF discourages the use of crypto. We will link that video in the description below. I hope that you find this video informative. If you like this video, hit like. And if you are interested in listening more about topics like these, consider subscribing. If you never want to miss an update from us whenever we post something new, hit that bell icon. If you have any comments, any suggestions, or any views on this matter, please post that in the comment sections below. Thank you.